Welcome and good morning. Today's session is Member Direct Investment Option, the next chapter. My name's Jared Mitzi. I'm from ME, which is otherwise known as ME Bank or Members Equity Bank, but we're now known as ME. So when I do refer to ME, I don't mean me, I mean ME the bank. So just to clarify that, marketing have made it very difficult for us these days, but we are a proud sponsor of this conference. And thank you for coming to this particular session. So the way we'll kick things off, we'll start with Jen. I think is the most appropriate person to start with, given UBS have seen the start and where platforms are now in this space, and what the future looks like as well for the MDIOs. So I'll throw it to you, Jen.
Great. Thank you, Jared. Good morning, everybody. Yes, as UBS has been a provider of platform technology in this space for nearly 5 years now, starting with one fund. We now have 5 funds live in the marketplace, and we're very proud to partner with those organisations. And I guess this is a great opportunity for us. It's fair to say that the focus has been, from an MDIO perspective, on providing members with the ability to buy shares in their portfolio. And that still remains a very important element, but we're starting to see that it's no longer just what MDIO is about. So if I was to recap on how we got to this point, and I know this is a conversation that's been going on for a number of years about what is an MDIO and what does success mean for it. We started with the ability for members to provide to access shares and cash in their portfolio. We actually started this evolution where there were even weekly trading. So you put an order in, and at some point at the end of the week you'd get an outcome, but you really didn't have control of that. So we evolved to straight-through processing. So for the last few years, members have been able to come in, buy trades. It's like having a CommSec account, only it's a UBS account, inside your superannuation fund. Panels of term deposits have been added. What we can see, term deposits have fallen out of favour largely because of the interest rates. So members are still holding term deposits, but only 3% of members who use our platform own TDs only. So as we've evolved, we started off looking at members just in accumulation phase. But in the last couple of years, we've also provided the ability for members to hold the same securities in pension phase. And more importantly, now provide the ability for members to move from that accumulation phase into pension without realising their assets. So for members who have taken a direct investment strategy, they can build it up over their life during accumulation and transfer it across without realising capital gains tax. So as we look at MDIO as being an equivalent to an SMSF or providing similar investment outcomes, that in-specie transfer capability is really important for those members. Having to force them to realise tax at retirement is clearly not a great outcome. We've also looked to improve the user experience. So it's fair to say when we first launched our proposition with our clients, the fact that members had to log in separately, there's nothing like putting in separate usernames and passwords as an absolute barrier to entry. So call centres are flooded with people who have to remember 2 sets of usernames and passwords, and it really is something that's preventing the uptake of these sorts of services. So implementing single sign-on so that the MDIO platform itself becomes part of the fund's technology ecosystem, that members can move backwards and forwards really simply. That's been important. We have launched advisor access. Now, providing advice to members at any point during their life is something that's very close to the attention of each of our client funds. We now have the ability for advisors to log on and have a look at the portfolios that their members have constructed and even take control and implement transactions and manage that investment strategy. And we've also launched the ability for advisors to charge advice fees. So that they can get paid in the way that traditionally IFAs get paid in the marketplace and charging fees against cash. So that was a milestone in the evolution of MDIO technology last year. We now support managed funds. So if you think about the MDIO technology, it now looks like a retail wrap. It's just sitting inside the superannuation fund. Now, from our perspective as the technology provider, we're product agnostic, but one of our clients recently launched their own investment option, so property and infrastructure options, now sitting inside MDIO. So that now allows MDIO to appeal to an entirely new cohort of members who aren't particularly interested in shares, but they want access to boutique or specialist investment options inside their fund. We've expanded through the range of listed securities. So we had ASX 300, now government bonds, hybrids, LICs, ETFs, those sorts of things. So everything is supported. We're not expecting that our client funds will add an investment menu that's like a retail wrap that's essentially everything, but we do expect to see the investment menu change in terms of its sophistication. And that is really hinging upon the ability for the technology to help members experience and make the right decisions in terms of what those choices should be. We add investment performance to the platform next month, and this is really the final milestone in terms of creating our foundations. So that performance information will allow members to see the way that their investment choices have performed. Now, it only deals with MDIO. We don't have the ability to provide member-level performance on the fund, not yet anyway. But if you're going to allow members the ability to make investment choices, then you really do need to tell them how they're going. So that will come in place next month, and we're really excited to see what that does to help members make informed investment decisions. Next year, we'll add model portfolios and international equities. Now, we're actually just adding those under the covers, if you like, plugging in the final bits to the engine room. We don't expect to see that translate anytime soon into a new proposition, but we're really excited about what it might do in the long term, and I'll come back and talk about that in a moment. So that's where we got to. From our perspective, we've really completed the development of the transaction engine that is MDIO. And it's fair to say if you were to look at any MDIO, the UBS ones or any of our competitors, they're transaction engines. They exist so that members can buy and sell the things that they need to buy and sell. But if I look at, and we will reflect today on the uptake of MDIOs and what have we learned through that process, one thing we've learned is that it's designed today as a one-size-fits-all. So we're expecting that every member really cares about shares. Every member wants to just come in and transact. And we can see the numbers of people who are using the platform tell us, and also the feedback we get from members, that that's actually not true. It isn't a one-size-fits-all proposition anymore. And we also know there's a profound barrier to entry, and that is because these options require members to make an investment commitment to even come in and have a look at what the platform has to offer. So a member has to make an investment switch. They have to move money out of their investment options, come across, start incurring fees before they can even see what value there is in the MDIO. That is a profound barrier to entry. And what we can see is that member behaviour is such, they may come in, they may transfer the minimum amount of cash, have a look around for a month, and then transfer that money back. Now that's disrupting their investment process. That's a really inconvenient way for a member to come in and experience the value. So as we look at what 2016 means for the UBS platform, we are going to remove that barrier to entry and make the platform available to any member of our funds, and how our funds structure that proposition will be unique and bespokely designed. But a member can come in and have a look around. So we are now focusing on the member experience. We think that an MDIO capability, an environment that's rich with research and fund content, information about the ETFs that are provided, educational videos, there's a wealth of content that's out there. If we can put it in a really easily consumed member experience, then it actually starts to provide value to every member. So I guess MDIO started looking at the cohort of members we like to call choice and control seekers, those that actively want to manage their portfolio. But we know there are members, we now call them curious dabblers. So they're members who might not yet be ready to invest in listed securities. They might not ever be ready to do that. But they are interested in how their portfolio is managed. They are interested in what other investment choices there are. So we're going to remove the barrier to entry, allow members of the fund to come in and have a look around, and then allow them to transition up that value chain through the proposition as they'd like to. So we would expect to see each of our clients issue free to access platform. It should be available anywhere, anytime. It's got appropriate and personalised information in it. Comes embedded with calls to action and education, and that when members are ready, they can easily transition and make that investment decision to start transferring their investments from their fund options into the investment options that are available to them. We also expect to see that the MDIO may then be broken down. So I've talked about all the asset classes that you can invest in them. What if members just want to hold cash? What if the cash is a really compelling investment choice? They just want to hold cash. Well, the current fee model doesn't necessarily make that attractive. So we will see propositions get launched that have different price points. So it becomes much more user pays. If you just want cash, and we know that 16% of the membership who use our platform actually just want to hold cash, then let's have a fee model that supports the consumption of those particular assets. And if members want to pursue the more expensive investment options, well, then they pay the prices that are appropriate for that. So we think that 2016 is about that. It's about the digital transformation, and everybody's talking about that at the moment, but we're really excited to see what we're doing on behalf of our clients is actually offering the MDIO, transferring it into what we call the investment hub. So for anyone who's interested in investments, it'll be available on a mobile, on web, on iPads, those sorts of things, giving them the ability to come in and just, I use the technical term mooch around. So come in and have a look at what the fund has to offer. So from UBS's perspective, we see ourselves as being a key member engagement tool. So MDIO, yes, it's about the direct investments that people can hold, but more importantly, it's about being part of the member engagement strategy for each of our client funds. So if we look beyond 2016, I mentioned the fact that we're adding in listed international equities and also model portfolios. Now, I actually don't see model portfolios or IMAs being rolled out as perhaps the IFA and retail market sees. But we could use model portfolio technology to enable a range of investment strategy outcomes, either that are supported by advisors or even supported by the funds. So the ability to create personalised investment strategies, have those investment strategies managed through automatic rebalancing processes, and those investment strategies could be across all of the asset classes, including the fund's investment options. So we're now seeing MDIO, excuse me, more from just being about the choices that individual members make. It's really, as we have conversations with our funds, it's about sweating the asset. These things are not cheap to implement. There's deep technology integration into core admin systems. Once you've made that investment, how do you get more out of it? So by taking the engine that is the MDIO, we think that there is a range of product creation opportunities, the ability for funds to offer investment options for smaller cohorts of members at a really cost-effective way. That just leverages the investment that they've already made to create MDIO. So the line between core admin and MDIO, the line between the investment choices of the fund and the direct investment options, we see that blurring. Our job is to be a technology enabler. Everybody's spent a lot of money investing in putting this capability in. How can we make more of it? So the model portfolios is something we're focused on. Also performance. What if we could calculate individual member performance across their whole fund experience? What if we could use that performance to send triggers to the fund, to have conversations with members who are doing really well or members who aren't doing very well? We could use that information to trigger conversations about being referred to an advisor or prompting members to reconsider their investments. In our view, if a member shouldn't be in the MDIO from a direct investment perspective, then they shouldn't. So let's tell them, let's give them the tools to help them make those decisions and allow them to continue to achieve their retirement objectives.
Thank you, Jen. I think you made a number of valid points there, particularly around the removing of the barrier to entry. I think is a really valid point, and also price points within the member direct option. To use a basic example would be around cash as well, and getting those retail cash returns, which I suppose in a self-managed super fund environment, self-managed super funds can access those retail cash returns. But thank you, Jen. That was fantastic. So just before we move on to Sam, I just wanted to take a moment to look at a couple of stats from the take-up rates of two of the major funds. So if we have a look at Host Plus Choice, currently got 1,700 members using MDIO with approximately 55 million funds under administration. And if you have a look at another major fund in Australian Super, Member Direct, you've got 14,000 members with approximately 740 million funds under administration. That was from stats from last month. But we'll move on to you now, Sam, as well. And obviously, you can make what you will of those statistics. But talking more about it being a tool for retention for funds as well, and I'd be interested to hear your views on that, and how effective that is as a tool for retention.
Right. Thank you, Jared. Thanks, Jennifer. Those of you that attended a similarly titled session 2 years ago might recall that I stood on that panel and said something like, "This is not a good idea." and I'm just going to reaffirm that view, if not somewhat stronger. Just because somebody gives you choice doesn't mean you should take it or exercise it. And it certainly doesn't mean that it's in your best interest to do so. You know, there's politics and there's marketing, and those considerations are critically important to survive in society, whether it's in superannuation or any other walk of life. But there's politics and there's marketing, and then there's the truth, right? And I could sit here telling you about the politics and the marketing, which you're well aware of, and I'm happy to do it. But let's start with the truth. It's always a good place to start, in my view. Choice, member investment choice in general, and direct investment options particularly, are not good for your financial wealth, right? At the end of the day, what is optimum in superannuation, if you are in the system, trapped in the system for 50 years throughout your entire working life, the best thing for you and me is to leave the money in a highly diversified option, go away and come back when you retire. That gives you the maximum balance. Along the way, you can transfer some of your balance to other people or back to the market, if you like, and that's what choice allows you to do, right? And so if you want to exercise that choice, that's fine. And the reason why we offer choice and we offer things that are not seemingly in your best interest is because if we did not offer that choice, you will simply go somewhere else and exercise that choice. But if you were captive to Host Plus, as an example, for your entire working life, there would be one balanced option, our best ideas, and that's what you would get, right? But that isn't the case, and so we offer choice as a retention strategy. People, if they're given a choice, they might decide to stay. If they leave because we don't give them a choice, they can exercise choice. They can ask for an option to be created. We would detect that and create yet another one for them, and they stay. But if they leave and go and exercise their choice somewhere else, it doesn't mean that we've done them a good service. And therefore it doesn't follow that we've done them a disservice by offering that option. They would get it anywhere else. As Jared pointed out, our member uptake has been modest. We launched this product on the 30th of December 2013, so it's about to have its second birthday, and the party hats aren't necessarily on, right? 55% of that, of the $55 million of member money that's in Choice Plus, our direct investment option, about a half of it, 55% of it in fact, is in equities. So we allow people to select from the ASX 300 and we allow them to choose amongst exchange traded funds, developed markets, emerging markets and commodity based exchange traded funds, and we allow them to have cash and term deposits as well. 15% of our members choose exchange traded funds, and about 30% of the members in Choice Plus choose cash and term deposits. But as I said, 55% elect to choose their own shares. What has the performance been like over, albeit admittedly, a particular 2-year period, but that's the only 2-year period that Choice Plus has been in existence? Well, let's start with the ASX. The ASX has returned roughly 12% over that 2-year period, cumulative return. The Host Plus balanced option, the diversified option to which I referred, has returned cumulatively 19% over that period of time, which is pleasing. And the Choice Plus members have generated negative 5% over the 2-year period. And that includes term deposits and cash. So imagine what the equity selection must have been like in order to achieve that outcome. It doesn't make me happy or smug that that is the outcome. Let me be clear about that. Right? This is member money. This is retirement money that they are playing with, and what they are doing is they are taking a small amount of their money, they are transferring it over to Choice Plus, and it's becoming a smaller amount yet again, right? And that's not necessarily good for them over the long term. Quite pleasingly, we see flows the other way. So people who have said Choice Plus is not for me and have moved back into the balanced option, that is good. But one of the reasons that we did it, Jared, initially was as a retention strategy. It's a way of offering an SMSF light product. In other words, you have some of the flexibility of running your own investments, but without the burden of administration and being your own trustee. So you could test, if you like, what it's like to be an SMSF investor if you wanted to go down that path. Where is the future for Choice Plus, for Host Plus? Well, in July of this year, we opened up Choice Plus to our pensioners so that they can also have choice. If we do not, they will go somewhere else where it's available to them. And so it is now available to our pensioners, and the next phase, I believe, is transferring in specie money from the accumulation superannuation fund over into the pension so that they can proceed and continue with Choice Plus into their retirement. So that's probably where I will stop for the time being. The summary being, if I had an option to remove member investment choice altogether, I would. It is not politically savvy to say that. It is not a good marketing concept, but it is nonetheless probably closer to what is in members' best interests. Thanks.
Thank you, Sam. And it's great to have these various opinions on the panel, and that's why we get you up here, so we can have that scale of opinion. Additionally, it's great to have Graham Colley with us today. He's one of the senior people in the industry, particularly around self-managed super funds and specifically around being the technical director of the major association, which is 1/3 of superannuation monies are in self-managed super funds, so it's important to hear this opinion as well. Really like to hear from you around education specifically, Graham, today, and some of the things that we can potentially learn and apply in the MDIO space, and making it clear that self-managed super funds and MDIO are completely separate things, but there are similar behaviours that go on. So I think that's also important to clarify as well. So over to you, Graham.
Thanks, Jared. I come from the thing that's perceived to be the engaged side of the tracks, unlike what Sam was talking about. And I think if member choice is really a flight to fancy, or we're trying to protect that flight to fancy, and that is a run on the large superannuation funds to self-managed funds and enabling that product, that being choice there, maybe that's the wrong way to look at it. And I think if you're not complementing that with some sort of education and getting people to understand how their investments react in various environments, then I think you've got a problem. Now, the way in which we see self-managed superannuation funds through the surveys that we've done is that we split our trustees into a whole range of ways. I mean, there's a gambling mentality in there, there's certainly a business mentality in there. And I noticed Jennifer talked about a few things there to do with those that want to control their destiny and things like that. So some of the surveys we've done are split the membership categories into three, and that is those that we regard as controllers, a second category that we regard as coach seekers, and a third category that we regard as people we call outsourcers. They're really the continuum because with controllers, if you go to a focus group with them, they're more like rednecks from the west of the US, and they'll tell you about gunslinging and all this sort of thing, and that nobody can tell them how to run their self-managed superannuation fund. They get their advice from random sources, friends, barbecues, those sort of people. They tend to speculate in the way they invest simply because they don't have any true plan, it's all random. And often they mention the word stockbroker as their financial planner. So that's a very one end of it. It's not very organised at all. We have seen a change from controllers into what we call coach seekers, and that is that those people who thought they could run it themselves, after they've had their self-managed superannuation funds for some time, realise that they do need some help. And they are transitioning into coach seeker mode. And coach seekers are those who I would expect most of you would fall within that category. You learn as you go along and you use other information that's around in the market, particularly from professionals, to work out where your superannuation should look and smell like, and help you with the planning of that superannuation fund. It may not be successful, and I mean, some of the examples that Sam talked about might be exactly how self-managed super funds work, but with coach seekers, at least they're seeking information about their superannuation fund. They're looking at asset allocation within that superannuation fund, and they're thinking of, and writing down the investment strategy for that fund. Now, they contrast to controllers simply because controllers don't write down things. They're random in the way in which they look at their self-managed fund, and they seek advice in a random sort of way. So coach seekers are the people that we would like as all people that have got self-managed superannuation funds, simply because of the engagement they've got and the interest they've got in the way in which those funds have run. Now, the third category we've got is what we call outsourcers. Some of those are probably not suitable for self-managed superannuation funds. Now, the reason why I say that is they hand over the operation of their superannuation fund to their advisor. Now, that advisor may be their accountant, it may be their financial planner, it may be somebody, even a trusted friend in some cases. They're not particularly active, they're not engaged, and they rely on the decisions of others. And in fact, in some of the worst cases, they hand over the chequebook to the particular advisor to make decisions on behalf of that superannuation fund. Now, from a potential point of view, those people are probably not the right people to have in self-managed superannuation funds. Often they don't have a great deal of money in self-managed funds. They're expensive to run the funds. They don't have a critical mass to run those funds, and maybe they're not the right people to have in that area. But coach seekers are the ones that we think are the gold medalists in self-managed super funds. Now, when you look at the driving forces behind self-managed superannuation funds, and from what Sam was saying, and I think that run-on funds is something that if that's what you're worried about, and that fear, which I think has gone away, you certainly need to think about that and how you really want to maintain those members. But the way in which I see the driving forces behind self-managed superannuation funds, the first catalyst for self-managed super funds is the accountant. There's no question about that. That relationship that a client has with their accountant is rock solid. And I was only talking to someone the other day, and these clients actually go away with their accountant on holidays. So to have that sort of relationship is very difficult for a trustee of a self-managed super fund. Okay, you've got a lot of holidays because I know how many members some of you have got. But that is a very, very personal relationship. It not only relates to their superannuation fund, but it relates to their whole business relationship that they've got there. So that's what you're competing against. It's that barrier that is created by the accountant. Now, why should the accountant have that? There's fees that come out of that. There's a whole, not only the fees relating to the superannuation fund, but also the taxation advice that they give and so forth. And I don't think it's the same with financial planners. Financial planners have certainly got an interest there, but not to that same personal taxation, absolute belief in what the accountant gives them. I think that with financial planners and accountants, the convergence of the licensing arrangements maybe over the next 5 to 10 years will be interesting to observe. The reason why I say that is with limited licensing coming in for accountants from 1 July next year, what will we see going forward from that? Will that mean that people are less, because accountants may be less likely to get into limited licensing arrangements or join together with financial planners that have got limited licensing arrangements, will that mean that they're less likely to advise that a self-managed superannuation fund is right for the client? Now, that may be something that changes or dampens down the transfer of money from your funds to self-managed superannuation funds. So I think that needs to be taken into account there. The other thing is market downturn. Now, I know we can't do a great deal about that, but my observation from work I did with my previous employer, where I looked after about 4,500 self-managed funds, market downturn was an absolute driver for people to go away from your types of funds to think that they can do it better themselves. And I only had to talk with someone last night talking about the fact that with their fund, they look backwards and their performance statistics are sort of retrospective, whereas when you're looking at some of the interest rates that are advertised around the place, they're all prospective, say for term deposits and things like that. So you're faced with that competition. You're looking backwards and publicising that, whereas your self-managed fund trustees are looking at what the market provides at the moment and how they may be able to do better than what you can do. The other thing is business decisions. Now, I don't think you can interfere with this because in some cases a self-managed superannuation fund does have absolute advantages over your types of funds, because people like putting their business property in the super fund, and if they do it properly through that structure, then it's certainly worthwhile from a cash flow point of view, from an asset protection point of view for small business and so on. So I think that's what a self-managed fund should be for, in that, you know, I can control my business, I can protect my business through the self-managed fund, and I can get certain tax advantages out of that. So that's how I see self-managed superannuation funds. I think the teachers that are in it, and I think the education side of things, is certainly with those coach seekers that I mentioned before. I'm not so sure about the controllers. They can stay in the Midwest of the US and be gunslingers, and I don't think they're very helpful for self-managed funds, and probably I don't know where they should be. Outsourcers, I think that they're probably better situated in the types of funds you've got, because they like that nurturing environment, they like to hand over things to that. Now, how you stem that back, I've seen some work done by one particular organisation at the moment with some larger superannuation funds, where what they're looking at is things like the numbers of times some of your members look at their superannuation balance maybe every day or every week or whatever it is. I don't know what they're doing if they're looking at it every day. But they're people that may be more likely to go over to self-managed superannuation funds. They're more fussy about their superannuation. They like to keep an eye over the portfolio, how it's performing day by day, which is a rather strange concept. And maybe they're the ones that would go over to self-managed superannuation funds more so than other ones that you've got, such as the outsourcer sort of person. So that's how I see self-managed superannuation funds, and I think it's the link with the education side of things that really means that, and those people who want to know about their superannuation, about asset allocation, and about goals and objectives of all our funds, whether it's a self-managed fund or an APRA-based fund, which is the really important thing.